Hello and welcome to this Thursday's morning market briefing. We've got lots to talk about, but firstly, the Federal Reserve officials were open to further US rate rises to quell inflation, as well as that Nvidia's revenue beats high expectations as AI chip demands climbs, and finally, Rishi Sunak calls July 4th UK general election. We've got lots to talk about on the charts also, with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure to subscribe. The first article to talk about is to do with the Federal Reserve. Now, some Fed officials in recent speeches have now signalled that they would be prepared to raise interest rates further should inflation become more aggressive. This comes following recent reports published which show a record of their last meeting at the start of May. Now, what is this kind of meeting that we're talking about here? Well, we're talking about that May interest rate decision, which of course we did cover at the time, and since then we've seen a great fallout in the markets from a range of economic data that's also come out following such a decision. Now, that decision did see the Fed keep interest rates at that kind of 23-year high, so not much happened there really. However, it was really the rhetoric, which we're now kind of talking about again, that made a difference in the way that the market perceived the Fed's monetary policy, as ultimately it was Jerome Powell's speech in the press conference following the interest rate decision where traders took a very kind of hawkish understanding of the Fed's monetary policy outlook, with Jerome Powell reiterating that the Fed's interest rates were likely to stay higher for longer really, and that the Fed was going to have to pursue quite a hawkish monetary policy kind of position to achieve inflation success by bringing inflation down, as ultimately inflation data and US economic data really since January, February, March has started to kind of show a worrying image with regards to inflation remaining persistent within the US economy, as of course ending off last year and starting off this year, like very much starting it off, we were seeing inflation on the decline, and this was creating that very dovish outlook which we talk about all the time, which the markets were both looking at the kind of interest rate position by the Fed through, and also the Fed was kind of taking that more dovish outlook as well, expecting 0.25 percentage point rate cuts this year. Ultimately, though, as we always say, that wasn't the case after, of course, a series of US economic data releases showing that in fact inflation is persistent within the US economy, and that it's going to take more to bring down inflation. And as a result of that, that's why we really did hear that rhetoric from Jerome Powell in that last May meeting. Since then, though, of course, it's essential to note that basically we have now received the more recent inflation figure within May, which did, of course, show that inflation was finally on the decline again. And this inflation figure did come in line with economists' expectations, well, certain economists' expectations, and others it came in below. So this was, a very kind of dovish figure, or at least it created this kind of more dovish outlook by investors and by the Fed, presumably. And so as a result, the market has started to price in such inflation data, and that's why we did see that kind of rally ending off last week in US equities and indices and that kind of thing. And that's why we also saw a significant sell-off in assets like the dollar, whereas we saw a large gain in assets like gold and Bitcoin. So that's kind of why we saw such price action, and that's kind of the current situation with regards to the Fed's interest rates and US inflation. What this article more so focuses on, though, is the FOMC minutes that were produced from that May meeting. So this is going back before that inflation rate figure that we recently received, and this kind of gives us a better insight into how the Fed may actually perceive this more recent inflation figure, as it kind of gives us an insight into what the Fed's long-term outlook is for monetary policy wise at the moment. So that's the kind of key thing to note, and what this FOMC minutes does kind of highlight it is that the Fed is kind of far more hawkish than I think many expect. And that is why, as we'll come to in the charts later, that is why markets are now pulling back somewhat on those gains that were made following that more recent inflation rate figure. So that's why this article is, of course, so important to note. And whilst, this is a topic that we're always covering, I think today, with regards to the FOMC minutes, this is kind of a figure which normally or a data release which we wouldn't, or news release more like, that we wouldn't really usually cover. But ultimately, I think it's so relevant after being released after the most recent inflation figure, which kind of contradicted most people's expectations. With this also coming following recent inflation data showing that inflation is on the decline in the US, which caused markets to perceive the likelihood of a rate hike lower. FOMC minutes ultimately, though, showed central bank officials at the Fed are still concerned over the persistence of inflation within the US. The meeting where the FOMC minutes are taken from saw the Fed keep interest rates at their 23-year high, with this being backed unanimously by the members of the FOMC. Following that decision, Powell and the other rate setters signaled that they were looking to keep rates higher for longer after recent economic data showed inflation was persistent. The more recent inflation rate figure, however, has led markets to now price in between 1 or 2 rate cuts for the year 2024, but the recent FOMC minutes release caused markets to slip, with the S&P 500 closing down 0.3% lower. Upcoming economic data will not only be pivotal for any rate decisions, but also will be pivotal in how Joe Biden is perceived as voters head into election season, which is, of course, another topic that we're frequently covering, because ultimately that kind of economic policy proposed by such political figures is, of course, always important to understand when we're looking at markets. That's all to talk about on this first article. Next article to talk about is to do with Nvidia, which of course we did cover yesterday, or at least we spoke about the kind of data that we did receive in yesterday, which is what this article does cover. That was a bit of a mouthful, but I think you get my gist. Now, Nvidia's revenue has soared 262% in the past quarter, with this beating investor expectations and sending Nvidia's share price higher. This comes as the company has also announced a 10-for-1 stock split on June the 7th. So of course, this was the topic that we were talking about yesterday, and of course was extremely relevant with Amazon adjusting their plans to integrate these new AI chips into their workflow, as ultimately at the moment we really are experiencing this AI revolution. And as we spoke about yesterday, the kind of key industry which is underpinning this revolution really is the chip making industry, and the kind of key powerhouse within such an industry is the likes of Nvidia, especially within the West. And Nvidia has recently come out with their most powerful AI focused computer chip, and that was the kind of key topic of the year thus far with regards to chip making and AI and that sort of thing. As ultimately, Nvidia's CEO had really come out and spoken wonders about this new chip, and really spoke about its power with regards to AI, especially with the chip being, I think it was 2 times more powerful than the previous with regards to AI. And ultimately, the chip is very good at handling these large workloads, these large AI language models, and it's very good at training such language models. So that's the kind of key thing that Nvidia was kind of talking about with regards to their new chips. But as a result of that, certain businesses don't want to use the older chips, which maybe they were thinking about integrating into their workflow, and now they want this new, more powerful chip. But the thing is, the gap between those 2 chips' release dates is not large at all, and as a result, it looks like we're going to see a large gap in revenues for Nvidia as we do wait for the latest chip that's been announced to actually arrive to customers, whilst certain customers avoid buying the older chip. So that's the kind of issue which Nvidia is somewhat facing. But ultimately, what this latest data release does show is that Nvidia is still on the upswing. We know recently that Nvidia had somewhat of a retracement with regards regards to its share price, but ultimately this kind of brings back this more positive sentiment with regards to such a powerful tech stock, and really it kind of provides that more optimistic picture at a time where maybe there's some kind of hesitations with regards to Nvidia's future and the situation with regards to their new AI chip. So definitely keep your eyes on Nvidia, with Nvidia also saying that they're raising their quarterly cash dividend to 150%. Record artificial intelligence chip sales have driven the revenue for the 3 months to the end of April up to the figure of $26 billion compared to the estimates of $24.7 billion. In the current quarter, Nvidia expects revenues of $28 billion plus or minus 2%. The figures released drove Nvidia's shares up by a full 2% in after hours trading. So a significant data release there, and as we spoke about just at the end there, it has great significance to Nvidia's share price. The last article to cover though very quickly is to do with British politics, with Rishi Sunak now calling a July general election. With the British Prime Minister Rishi Sunak has now made a huge gamble by announcing that a UK general election will take place on July the 4th. This comes as Labour lead more than 20% in opinion polls, and the election campaign for both parties is now set to last 6 weeks, with party officials at the Conservative Party saying that there was no point to try and hold on until autumn. So is of course a very significant article with regards to UK politics, and this will have a great impact on both the UK market, but also will have a great impact on kind of world tensions and kind of the world volatility, as ultimately this year is full of politics really. We not only have the US election, but also the UK, as I just spoke about, and also some EU elections which are also taking place. So lots of kind of politics to look out for, which always affects markets because of the volatility it does bring and the uncertainty that it does bring. And of course, both the Conservative Party and Labour Party advocate for very different economic policies, and as a result that also has a great impact on markets, especially it will have a great impact on the pound, as we've seen before with the change in political leaders in the UK has had a great impact on sterling most certainly. So that's why this is always important to cover. That's all to talk about in the articles though. Next to talk about, as always, is of course the charts, where like always as well we're beginning on the US 30, talking more broadly about the US indices as a whole. Now what we're largely seeing here, as I've drawn out, is kind of this retracement that the US 30 is currently undertaking. Now, why is this happening? Well, we could put down this to multiple factors, whether that be the inflation data that we received last week still coming in line with economists' expectations, so this is the markets now fully pricing in that reality. Also, we could factor in the more technical side, which is that we're really starting to see that we saw this bearish divergence form on the US 30, and as a result it does make sense that we would see somewhat of a retracement or a sell-off, but also we could factor in the FOMC minutes that we've received yesterday, which was the first thing that we spoke about today, as ultimately whilst that doesn't change the inflation figure that we saw last week or received last week. Ultimately it kind of puts a downer on it. It brings to light the still very hawkish reality which most Fed officials see and present, and as a result of that, it brings into question the relevancy of the inflation figure and whether that will have enough of impact on the Fed's outlook for us to really start to see any changes in the market and that kind of thing. So that's why we might be seeing this sort of retracement. Interestingly though, in yesterday's morning market briefing, I did kind of suspect that somewhat of a retracement was coming. Not only do we have the technical factors, but like at the start of the charts, I did also link back to the kind of reality that inflation figure does present. And so as a result, I did of course say that I was somewhat expecting a retracement, and the key area which I expected price to really retrace down to is this liquidity zone which price is currently sitting in, which lines up with this 6180 Fibonacci retracement level. And as I said, just repeating once again, it also sits in that kind of key liquidity zone, which has previously acted as a strong area of resistance, but now is seemingly going to act as somewhat of an area of support. So I did note that it was likely that we would see somewhat of a kind of retracement down to such a level before and then a continuation higher, as the kind of overall macro perspective on US stocks still seems positive. Ultimately, interest rates are going to come down at some point, and that inflation data does show that inflation is on the come down. So, the kind of macro perspective is still positive for the US economy and US market. And so overall, I'm still expecting that kind of continuation to the upside, but nonetheless, that kind of retracement was to be expected as well. Next to talk about though is the dollar, which, reversing the image on the US 30, really, we're seeing a kind of retracement to the upside for the dollar, with price finally reaching this 61.80, which was kind of the key level which we expected price to retrace to back in mid-May, so the 16th of May, basically last week exactly. That is kind of where we expected price to retrace back up to, as it lines up with this kind of key liquidity zone, which has previously acted as a strong area of resistance, but also a strong area of support. So that was kind of a key area which we expected price to interact with. Price did not make its way up there though for quite some time. Price had reacted to that 50% and kind of signaled somewhat that price was going to continue lower, but we never saw that, and that kind of FOMC minutes that we did receive yesterday has now pushed or allowed for the dollar to kind of swing higher somewhat. This, though, just like I said on the US 30, could be the end of the retracement, though, coming to this kind of key liquidity zone and Fibonacci level, and therefore we could also be expecting price to now continue lower from this level. So keep your eyes on the dollar. Of course, that lower level which price could gravitate to is that minus 27.2% Fibonacci extension level, which lines up with that key liquidity zone. Next to talk about though is Euro USD, which drops on that kind of on the back of that FOMC minutes release. So that's kind of obvious, but still no price action here is kind of very significant or kind of tells a very interesting picture. Instead, we're kind of seeing this slow move to the downside. It will be interesting to see though whether if price is on the downside or the swing to the downside for the moment. It will be interesting to see whether price can make its way down to this key liquidity zone. So keep your eyes on that. Next to talk about is pound yen, which today we did, yesterday we did receive a key inflation rate figure from the Bank of England, I believe, or the British inflation rate figure. Yes, we did. So ultimately, that was very important to how that affects the pound and that sort of thing. And the inflation figure did come in very low, and as a result of that, we're now seeing pound move less so to the upside than we would usually expect. So whilst the pound has been very positive lately, such a figure we would expect to cause the pound to sell off. We haven't seen that, and instead we've seen the pound continue higher. Nonetheless, keep your eyes on pound yen, as we are kind of pushing it further and further into uncharted territory and nearing that 200 pound for a yen. 200 yen for a pound mark. Next to talk about is Bitcoin, which just like other assets has retraced yesterday, and that's also as a result of that FOMC minutes data or figure or news release. With, as I've said many times, Bitcoin really is dependent on the Fed's monetary policy. And if we are hearing hawkish monetary policy from the Fed, then we are going to see, negative price movements on Bitcoin and, bearish price action. And that's what we saw yesterday as a result of that FOMC minutes, which is why we're seeing this retracement. But I did somewhat predict it. I did somewhat say that this was likely, and that's why I did mark out this 50% Fibonacci retracement level, which lines up with this key liquidity zone. So it will be interesting to see now whether price can swing off that level and continue to older highs or even new highs, which line up with this Fibonacci extension level. So keep your eyes on Bitcoin most certainly. Next talk about though is gold, which is an interesting level after selling off significantly following the FOMC minutes release. That arguably is also because price was largely overbought at the time that that figure came out. So, it kind of all wound up into one move, and that's why we saw that significant sell-off. But price has now made its way down to this 6180 on this longer term Fibonacci retracement tool. Lastly, to talk about though is oil, which, has kind of broken now below this shoulder line, which had formed this kind of shoulder line head and shoulders pattern. That said, it still hasn't totally broken it because it hasn't broken this the head of the head and shoulders pattern. So it'll be interesting to see whether price does do that, or in fact will this head and shoulders pattern now play out on oil. Keep your eyes on oil and any Middle East news. That's all to talk about on the charts. Lastly, to talk about, like always, is of course the economic calendar. We're receiving a great deal of data today. Now firstly, we are receiving the Aussie manufacturing and services figure, followed by that receiving the Aussie inflation expectations figure, as well as the French manufacturing and services figure, followed by that receiving the German manufacturing and services figure, as well as the Chinese FDI figure, as well as the Eurozone manufacturing and services figure, followed by that receiving the British manufacturing and services figure, as well as the US jobless claims data and the Eurozone consumer confidence figure. So lots of data to listen out for today, but we've covered lots in the articles, lots in the charts, and lots in the economic calendar. Hope you have a great trading day. That's all from us at Wildwood Capital. Have a great one. See you later. Bye.